please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
We have to hold our nerve. That is the message from top finance ministry officials that we've been speaking to as the government battles a falling rupee and rising fuel prices. The Prime Minister is scheduled to take stock at a crucial meeting tomorrow. On the eve of that meeting, there were hectic parleys in the corridors of power. Finance Minister Arun Jaitley, along with his team of secretaries, briefed the Prime Minister. So what should the government do tomorrow? Should they unveil measures to stem the fall in the rupee and rein in fuel prices? CNBC-TV18 conducted a poll among top market participants, and here is what they are expecting. A majority, that's 80%, believe that there is no need for the government to act at the moment, and 20% respondents feel that there is in fact need for some action. In fact, a similar majority of 80% are not even expecting any major announcements after tomorrow's meeting. But since Wednesday, when this news broke of the Prime Minister's weekend review meeting, the stock markets have rallied and the rupee has recovered some of its losses. So joining us now to discuss what we can or should expect is the former Chief Statistician of India, T.C. Anand, Senior Economist of Kotak Mahindra Bank, Upasana Bharadwaj, the Chief Economist of Citi, Samiran Chakrabarti. Samiran, Ms. Anand and Upasana, appreciate you joining us here on the CNBC TV18 special. Ms. Anand, let me start by asking you, and this is the sense that I get speaking with government officials, senior government officials, that we have to hold our nerve for now. We cannot be seen as being reactive to the fall that we've seen in the rupee, which the government clearly believes has been a result of overshooting, and the fall and the recovery that we saw on Wednesday is on account of profit taking. Do you believe that this is going to be a meeting that reviews, weighs various options, but holds the fire for now?
I'm not aware of what the context of the meeting is, but government regularly does hold meetings of its senior economic policy makers to basically take stock of the situation. So I won't read too much purely on that account. Insofar as the rupee is concerned, I think we are reading far too much into the depreciation of the rupee vis-a-vis the US dollar, because if you were to look at all the composite indicators, looking at terms of what the real exchange rate is and what is happening to rupee versus other competing currencies and our trade-weighted exchange rates, I don't think we have such a ground to worry. So in fact, my personal reading is in line with what most of your market experts have been saying, is that I think this is just people wanting to write on something and therefore making an issue out of it. It's really not an issue.
Okay, it's a non-issue. Samiran, would you agree? Are you part of the 80% that believe that measures at this point in time on part of the government or perhaps even the Reserve Bank unwarranted?
Well, Shireen, we have to look at it in a slightly broader context. It's important now to identify what is the root cause of the problem. If the identification is that the root cause of the problem is a structural trade deficit issue, then what I would want to hear from the government is that what's the framework under which that structural trade deficit will be addressed. If we get a framework of that sort, then possibly for the time being the markets will be taking some solace from it. The other option is to go to the other extreme and say that no, this is all speculative, and the speculative action has to be tackled by higher interest rates, etc. Then that's a different framework that we are talking of. So which is the framework that the government is thinking at this moment in itself will be a big guidance for the market. For now, the only signal that has come through the announcement of this meeting is that the level of exchange rate is not comfortable from the government standpoint, which in itself is a signal for the market.
That in itself, as you pointed out, is a signal. But I want to go back to the point that you made on identifying the cause, Samiran, and whether or not we should expect or should look forward to some sort of measures being announced to correct these structural problems to deal with the trade deficit. Now, some relief that the trade deficit number that's come in has come in lower in comparison to the 18 billion plus that we saw for the last month. But what would you expect then? Do you expect import curbs, more import curbs? Do you expect export incentivization? I mean, what is it that the market realistically expects on this front?
Well, in my view, it's too early to announce the granularity on these kind of things of export measures or import control measures. It takes time to figure out the line items and exactly what policies can be announced on them. But the broad structure is important. The broad structure we would like to hear is that the government wants to boost exports, and whatever are the non-important imports. Particularly what I'm referring to is that you have noticed that electronics goods imports have reached more than $5 billion a month. It's increasing every month. And can we do something about it? These are the things which will help us understand a structural decline in the trade deficit, not just reacting to one particular number or one particular level of the exchange rate, which is treating the symptom, not really the cause. So I would rather want to see the cause being treated, not really the symptom.
And I don't know whether we will hear anything on the cause itself being treated at the end of tomorrow's meeting. But that, of course, as Samiran pointed out, is an expectation that is an important one that would require government clarification. But Upasana, let me come to you. And I want to go back to the interest rate issue, because a lot of the government officials that I've been speaking with seem to suggest that, you know, the interest rate as an instrument as far as the rupee depreciation is concerned should not really be used. I mean, let the RBI focus on inflation targeting and the view, even in our poll, is that whether it was the possibility of a mid-policy action on the part of the Reserve Bank, most market participants, in fact 10 on 10, believe that that shouldn't be the case. Is that your view as well? And what would you then expect from the October policy?
Well, Shireen, I think, you know, if you were to just put this in perspective, if you look at the FPI flows, we really haven't seen much of an outflow from the FPIs since the month of July, right? It's kind of stabilized. Maybe briefly in September, we've again seen the resumption of outflows. But otherwise, more or less, since July, we haven't really seen FPI outflows to the extent that should warrant really much of an action. You know, if we were to recall the 2013 period, that's when within 2 months or so, we saw a huge outflow. We saw almost close to $14 to $15 billion. And that is within a very short period of time, we saw rupee depreciate by almost 24%. That was within a short period of time. Right now, since February till now, we are rupee has depreciated around 12 to 13%. That is after a significant period of stability. So clearly, somewhere, we need to realize that the speculative positions are not as dominant right now, and any intermittent rate hike or an aggressive rate hike is really not warranted, because we do not achieve much with that. And especially we have to keep this in mind that, you know, rest of the other EMs are also hiking rates, right? And at this point, we need to take into account, yes, what is the impact of the rupee depreciation on the inflation trajectory going forward. If that is really providing an upside risk, then that is where we can expect RBI to act. And hence, we are expecting a 25 basis of a rate hike in October. But I do not see a reason for an immediate before a policy rate hike or even an aggressive rate hike. I think we should be taking it slowly and seeing the impact, how that really pans out, because most of the near-term readings on inflation are relatively benign. So, you know, 2013, inflation was averaging around 10%. We are currently less than 5%. So somewhere, the dynamics are not as scary as, but of course, like Samiran pointed out, yes, there are other structural issues which need to be addressed more urgently. And hence, probably from the government tomorrow, we should probably get a roadmap from a medium-term perspective, how exactly we can address particularly the surge in electronic imports. That's extremely crucial. And also, I think one important point, for instance, you know, at the margin, I would believe that a switch away from crude oil dependency towards other sources of energy, that roadmap is also equally important. And yesterday, the kind of announcements that we heard on the ethanol side, I think that's really a progressive move.
Ethanol,
and probably many more such measures, many more such measures which should structurally help us curb our oil and electronic imports would be much more fruitful rather than reacting immediately through curbs.
Important point that Upasana brought up there, Ms. Anant, and let me get you to react to that this is a very different situation when we compare it to 2013, be it inflation, be it growth, be it FPI outflows. We're looking at a very different dynamic. Most of the problems that we're faced with, or at least a significant portion of the problems today, are not under our control necessarily. So in that context, you've, of course, at the start of the show pointed out that you don't expect any specific announcements to come in from the government, and you don't believe that's necessarily warranted at this point in time. But if indeed the government were to act in terms of both fiscal as well as monetary policy, what do you believe will be the preferred options?
Look, insofar as fiscal policy is concerned, I think the government should stay the course with what it had announced at the time of the budget, and there is no need to react in any significant way insofar as fiscal policy is concerned. The government has adopted a very sensible approach insofar as the fiscal policy is concerned. Insofar as the monetary policy is concerned, I think it is important to emphasize something which I'm going to slightly disagree with Upasana. I think this fear of inflation which is being made out is actually overblown, and what is likely to happen is at the end of the year you will probably find that RBI has once again overestimated the level of inflation which is to be achieved. I think we should be very cautious. Let me make a point here. I think we should be extremely cautious in how we read data and interpret it, because the risk is that if we take a very, very pessimistic approach on inflation or the risks from FDI and so on and go in for rate hikes, we are likely to put a much heftier squeeze on the investment process which is reviving. I think at this point it is necessary for everybody to just stay the course. The inflation is well under control. In fact, I think RBI needs to take a step back on its fears of inflation, fears that the sky is not going to fall on our heads.
Okay, let me check if Samiran agrees with you or agrees with Upasana, and he's also a member of our CNBC-TV18 Citizens Monetary Policy Committee. Samiran, which camp do you belong to, the Upasana Bhardwaj one or TC Anant on the program today?
So my last report is titled Weak Inflation and Weak INR. It's a conundrum for RBI. And I really believe that unless the INR really blows out between now and the October policy, it's difficult to justify a rate hike at this juncture. We have reduced our average inflation forecast for FY19 from 4.8 to 4.5% on the back of this last couple of prints. So purely the core mandate of MPC is inflation. So on that basis, justifying a rate hike is difficult. The MPC will have to widen its ambit a bit and start thinking about how financial stability can impact inflation going forward, and then justify a hike, which is, in my view, a bit drawn out. But having said that, if the exchange rate really weakens between now and the October policy, the rate hike remains as an option on the table, if not for anything else, just to buy out a bit of time before all these structural concerns get addressed through other measures. I don't think interest rate hike at this moment is a solution to our balance of payment problem or funding the balance of payment problem. It's just simply a tool to buy time.
Absolutely, and as you pointed out, I think there's consensus here on the panel, maybe slight difference there with Upasana, that the RBI should act with at least a 25 basis point hike come the October policy. But Samira, and I want to get each of our panelists to comment on this, the other big elephant in the room that the government is going to have to grapple with is the issue of what you do with fuel prices. Now, we've seen crude prices globally surge, and what I'm given to understand from government officials is that, look, we want to hold fire for now because we don't know how the Iranian sanctions are going to play out. But the political demand to cut is strong. So finally, it is going to boil down to the Prime Minister's call. But the pitch from North Bloc is don't act now because we don't fully understand how the Iranian situation is going to play out. Mr. Anant, would you think that holding back any cut in excise, or at least pushing the states to do what they can on VAT, is the preferred option at this point in time?
Look, on the fuel price thing, I think reacting to this political call is not good economics and certainly not good policy. I think the government has done a very sensible thing by keeping taxes on petrol high. It meets a number of long-term objectives. It promotes the long-term cause of switching away from petrol and diesel-based power to other sources of power. And to that extent, we should stay the course on this. It's environment friendly. We have been complaining about the fact that excessive use of petrol and diesel is harming our environment. It is also the fact that it is keeping our import situation and fiscal foreign exchange trade deficit under control. For a variety of reasons, this is a very sensible policy to follow, and we should not react to essentially what is a self-serving middle-class demand that give us a sop at this point to take what would be a very bad policy decision if we were to cut excise taxes at all.
Okay, so don't cut excise. That's the view there from TCA. Anant, echoing what the Ministry of Finance certainly believes at this point in time. Samiran, I'll come back to you. And I am given to understand that even in the first quarter, there was immense pressure on the government. In fact, the suggestion was that at least a 5 rupee cut per litre was warranted, that the central government take a 2 rupee excise cut, states cut VAT by 2 rupees, and OMCs absorb about a rupee. But that finally was turned down by the Prime Minister. You know, we just heard Raghuram Rajan as we were talking about 10 years of Lehman, and Rajan's message to policymakers here in India was absolutely clear. We need a responsible budget. Don't go into fiscal profligacy ahead of the 2019 elections. Do you believe that any change on the fuel taxes at this point in time is going to cost us when it comes to the fiscal deficit?
Absolutely. In fact, I would go one step further in saying that whatever retail price you will reduce by cutting back on taxes, what if the exchange rate depreciates 1% more and completely neutralizes it? So the crude arithmetic is that $1 per barrel increase in oil price and a 1% depreciation both acts equally on retail prices. So if we cut taxes but exchange rate depreciates, the whole effect gets neutralized. So I would not be suggesting cut in taxes at this point of time to bring down retail prices, because at this moment where our fiscal numbers are not really looking great, we have real concerns of meeting the 3.3% fiscal deficit target. This will be playing with fire, particularly with foreign investors who are looking at our current account deficit very closely, and if fiscal also starts slipping, then we have the classic twin deficit problem, and that impacts the currency more than anything else.
Absolutely, Upasana. So we don't want to have a situation where we're battling the twin deficits. But, you know, if, as I pointed out, there is immense political pressure, if that political call were to be taken to cut excise on petrol and diesel, you know, the Ministry of Finance is worried about the multiplier impact, what it would do to bond yields, what it would do to the rupee, as Samiran has just pointed out. What is the message that the market will take from that? And what could it finally mean then in terms of borrowing costs for the government?
See, Shireen, I think what's happening is in the market there is already uncertainty on the likelihood of 3.3% being achieved. If we look at on the revenue side, the GST collections, the government itself has come out saying that they were expecting about 1 lakh crore per month on an average. And as of now, obviously, the run rate is much lower. So already there are concerns on that front. And along with that, if we were to see excise duty cuts, then that's definitely going to bring about much more slippage concerns in the market. At this point, about 0.2% is a slippage which markets have kind of, they're getting, it's getting priced in the market. But with the excise duty cuts, there is going to be a chance of a much bigger slippage and much higher borrowings, which clearly in this circumstances when bond yields are already high and the spreads over the repo are already at record high levels, definitely distorts the markets much more. So this is going to be inflationary. This is going to widen the twin deficit, and like Shamran said, further cause it's a vicious cycle. So rupee is going to depreciate much more, and that's when we probably will reach a severe point of crisis. So in order to avoid all that, I think it would be much more prudent for the government to hold on to the cut in excise duties.
Okay, hold on to the cut as far as the excise duty is concerned. Mr. Anand, let me come back to you now, because one of the concerns, and it is a concern acknowledged now by the Ministry of Finance, is what's happening on GST collections, something that Upasana was just talking about as well. I mean, we've now tapered down to that number of between 93 and 95 odd thousand crores, and that's the kind of number that we expect, at least for the next few months, is what I'm given to understand from my conversations with government officials. They're hoping that this will be offset by the mop-up on the direct taxes front. But this is also going to be a significant sort of variable that the government will have to weigh as it gets ready for an election year.
Well, there are 2 or 3 things which we should keep in mind. Of course, there will be some offset from the direct taxes front. The growth is looking good, so and since they have cut rates recently, I hope that will also feed into the growth picture, so that is another factor looking ahead. And finally, I think there is something which we are ignoring. The government had been levying a cess to provide for compensation to the states, and in fact, that is not being required in the extent which people had anticipated. So there may well be a cushion available if they can work out an arrangement in the GST Council in deploying this money between the center and the states to keep both their deficits down. That's something which I've not worked on myself, but I think is something which we need to take very careful look at.
Okay. Now I want to go back again and ask you a much broader question. And Samir, and I'll start by asking you, because you said that you would like to see a roadmap from the government in how it hopes to address structural issues, especially when it comes to the current account deficit and the trade deficit. While our poll does suggest that the market is not expecting any specific announcements, what would you expect would be the bond market reaction as well as the rupee market reaction on Monday morning if, in fact, there are no specific announcements?
Well, it's going to be a tough one for the markets because clearly, as I was mentioning, that the demand-supply balance in the currency market is against INR. So if for some reason the market is not satisfied with the kind of announcements that come over the weekend, then that balance just worsens immediately, and that could have a knee-jerk reaction on the currency market for sure. And bond markets at this moment, they're just simply tracking the currency market, nothing else. So what will matter for the bond markets is simply how much INR has moved on that particular moment. So in that sense, there is always this risk when you announce such big meetings that you fail to deliver on the nitty-gritties of the announcements. But I hope that all that will be very knee-jerk as long as the broad framework is put in place on how to tackle the structural problems. At least from my side, I can say that I will be quite satisfied from this meeting.
Okay, Upasana, your view on if there are no specific announcements that come in from the government at the end of this review meeting?
Yes, I agree. As in, if you look at the moves in INR and the bond markets, INR has, appreciated almost by 125 paisa or a little over that, in fact. And bond markets also, we've seen like almost a 15 basis of a correction since the announcement came. We have to, for bonds, of course, crude oil prices will also be important. But having said that, if on Monday no concrete measures are announced, definitely there'll be a lot of disappointment in the markets, and there will be a fair amount of reversal that we've seen in the last 2 days. So definitely we will be probably moving towards the similar levels as we were 2 or 3 days back.
Okay, so you're saying around 73, that's where you see the rupee depreciating back to?
Yes, it'll be closer to those levels, if not exactly the round figure.
Okay. Mr. Anand, I'll give you the final say, sir. You believe that this is a time when the government should weigh its options but hold its fire. But as we've just heard from both Samiran and Upasana, we will perhaps see a knee-jerk reaction should there be no announcements. We don't know whether the government will or won't. We've only presented the context of what the thinking is within various departments and various ministries at this point in time. The final call, of course, will be with the Prime Minister. But if there are no specific announcements, what would you expect will be the reaction?
I don't know. It's very hard to figure out how markets react to in terms of what they're expecting. So I'm not going to try to put my head into that exercise. What I think I would like to see the government do, and whether it doesn't matter whether it announces it in terms of a clear-cut statement or not, but a much clearer strategy of, in fact, having more regular conversations about the state of the economy from its principal economists and people in charge, so that I think they don't allow these, if you like, market expectations to go out of whack and increase the level of conversation which takes place from market policymakers, government policymakers, and what the market would like to listen. So I think that there needs to be a strategy of communicating better, which may have been lost sight of in some months.
Okay, so not just talk up the market, but talk more to the market. That's the message from the former chief statistician, T.C. Anand. Samiran, would you agree with that? And I'll close the program with that.
That will be a good move. We have already instituted the Prime Minister's Economic Advisory Council. It will be good for the council
to communicate
with the markets.
Which hasn't met since May.
So
the PMEAC hasn't met since May.
Professor Anand is referring to. That's what Professor Anand is referring to, that we need to have these meetings more frequently. So that what will happen is that market will not just wait for that one divine moment of this meeting to happen and then have all their expectations around it. If it happens on a more frequent basis, then obviously the messaging will be more clear and more consistent.
More consistent communication, that'll make life a lot easier for us here in the studios as well. But Samiran Chakravarti, Upasna Bhardwaj and T.C. Anand, appreciate you joining us here on the CNBC-TV18 special as we take stock of the Prime Minister's review meeting of the economy, what the market expects and what the government and the Reserve Bank should do. We'll say goodbye and keep tracking this development. For now, thanks for watching.